So guys, it's been some time since I've been loading the last video. Well, in this video I don't plan to intrigue any form of further debates or arguments. In this video I will be reading through this amazing piece of article. Okay, so the website is The Economist. So this article is rather very interesting, and I thought that it would be quite educational to share with other my followers, and also my viewers of this YouTube channel, because this is originally what we do in this YouTube channel. We share and learn new things. We're not here to debate, we're not here to shout at each other, we're not here to waste any energy or anything like that. Okay, so this is the article, and it explained how our modern financial system is being built, and it tracks back to the previous history. It all started back up 100 years ago. So this article is rather interesting, so I may start reading it from now, and I will share a little bit of my view of how I'm viewing the entire economy system, and hopefully be able to share information that would be helpful for my readers. Okay, thank you guys. So let us begin now. So 1792, the foundations of modern finance. If one man deserves credit for both the brilliance and the horrors of modern finance, it is Alexander Hamilton, the first Treasury Secretary of the United States. In financial terms, the young country was a blank canvas. In 1790, just 14 years after the Declaration of Independence, it had 5 banks and few insurers. Hamilton wanted a state-of-the-art financial setup, like that of Britain or Holland. That meant a federal debt that would pull together individual states' IOUs. America's new bonds would be traded in open markets, allowing the government to borrow cheaply. And America would also need a central bank, the first bank of the United States, BUS, which would be publicly owned, which is so different from the Federal Reserve today. Okay, so this new bank was an exciting investment opportunity. Of the $10 million in BUS shares, $8 million were made available to the public. The initial auction in July 1791 went well and was oversubscribed within an hour. This was great news for Hamilton, because the two pillars of his system, the bank and the debt, had been designed to support each other. To get hold of a $400 BUS share, investor had to buy a $25 share certificate or scrip and pay 3/4 of remainder not in cash. But with federal bonds, the plan therefore stoked demand for government debt, while also furnishing the bank with a healthy wedge of safe assets. It was seen as a great deal. Scrip price shot up from $25 to reach more than $300 in August 1791. The bank opened that December. So this is the chart, and how Hamilton is setting up the first bank, and this entire system that he's designing, as you can see from here. This is the routine of BUS. The first ever United States central bank was set up. Okay, so two things put Hamilton's plan at risk. The first was an old friend gone bad, William Dorr. The scheming old Etonian was the first Englishman to be blamed for an American financial crisis, but would not be the last. Dorr and his accomplices knew that investors needed federal bonds to pay for their BUS shares, so they tried to corner the market. To fund this scheme, Dorr borrowed from wealthy friends, and by issuing personal IOUs from the public, he also embezzled from the companies he ran. The other problem was the bank itself. On the day it opened, it drove the nation's other lenders already massive. It then ballooned, making almost 10.7 million in new loans. In its first 2 months, awash with credits, the residents of Philadelphia and New York were gripped by speculative fever. Markets for short sales and futures contracts sprung up. As many as 20 carriages a week raced between the two cities to exploit opportunities for arbitrage. The jitters began in March 1792. The buzz began to run low on the hard currency that backed its paper notes. It cut the supply of credit almost as quickly as it had expended it, with loans down by 25% between the end of January and March. As credit tightened, Duer and his cabal, who often took on new debts in order to repay old ones, started to feel the pinch. Rumors of Duer troubles, combined with the tightening of credit by the BUS, sent America's market into a sharp descent. Prices of government debt, bus shares, and the stocks of the handful of other traded companies plunged by almost 25% in 2 weeks. By March 23rd, Duer was in prison, but that did not stop the contagion, and firms started to fail. As the pain spread, so did the anger. A mob of angry investors pounded the New York jail, where doers were being held with stones. Hamilton knew what was at stake. A student of financial history, he was aware of that France's crash in 1720 had hobbled its financial system for years, and he knew Thomas Jefferson was awaiting in the wings to dismantle all he had to build. His response, as described in a 2007 paper by Richard Siller of New York University, was America's first bank bailout. Hamilton attacked on many fronts. He used public money to buy federal bonds and pep up their prices, helping to protect banks and speculators who had bought and inflated prices. He funneled cash to troubled lenders, and he ensured that banks with collaterals could borrow as much as they wanted at a penalty rate of 7% than the usual ceiling. So here, this is William Duer. He was born in Devon and educated at Eton. William Duer moved to America as a young man and made a fortune selling supplies to the army. Scams funded his expensive lifestyle. He once sold half of the land in Ohio, even though he did not own it. He conned so many people that by the time he ended up in jail, it was said that to be the safest place for him. So this guy is basically the badass. So this is explaining the first ever, I guess it could be said as the first bank bailout ever happened. So the first ever bank bailout, you see there's true wisdom of Hamilton. So Alexander's legacy. So after the bailout, the securities traded went up, so it worked. Even as the medicine was taking effect, arguments about how to prevent future slumps had started. Everyone agreed that finance had become too frothy, seeking to protect naive amateurs from risky investments. Lawmakers sought outright bans, with rules passed in New York in April 1792 outlawing public futures trading. In response to these aggressive regulations, a group of 24 traders met on Wall Street under the Buttonwood tree, the story goes, to set up their own private trading club. That group was the precursor of the New York Stock Exchange. Hamilton's bailout worked brilliantly. With confidence restored, finance flowered. Within half a century, New York was a financial superpower. The number of banks and markets shot up, as did GDP. But the rescue had done something else too. By bailing out the banking system, Hamilton had set a precedent. Subsequent crises caused the financial system to become steadily more reliant on state support. So I think this piece of article is very interesting. The reason why is that it explains that the very early Central Bank of America and the very, very early formation of traders. So as you can see, this is how the super financial power came together, and how the first bailout was able to put out, and then basically gives you a glimpse of how financial power has been accumulated and formed in such a super nation. So today, thank you guys for watching. If you like my content, please share and subscribe. This is a platform that I'm building to attract people with no political bias at all, and people who really want to learn and to come together and to share our knowledge and to discuss about human future. So thank you guys for watching. Please subscribe, press that like button for me, and please share. Thank you guys for watching. I'll see you in next episode. Bye.